An EU-US trade deal could cost the pharmaceutical industry up to $19 billion, according to analysts. Analysts stated on Monday that the introduction of a 15% tariff on branded medicines as part of the trade agreement between the European Union and the United States could cost the pharmaceutical industry between $13 billion and $19 billion. One of the analysts stated that unless pharmaceutical companies take action to lessen the impact of the tariffs, the added costs could raise consumer prices. Pharmaceuticals had historically been exempt from duties. The EU imports approximately 60% of all pharmaceuticals to the United States, making medicines the most valuable European exports to the United States. European officials stated on Sunday that pharmaceuticals were included in a bilateral trade agreement for a universal 15% tariff, with the exception of some generic drugs, for which there would be no tariffs. The U.S. has been conducting a national security investigation into the pharmaceutical sector, and the industry has been bracing for separate sectoral tariffs. Prior to negotiating the bilateral agreement, President Donald Trump stated earlier this month that pharmaceutical tariffs could reach 200%. Some Wall Street analysts said that they do not expect additional tariffs on the EU as a result of the investigation, but others cautioned that the deal was not yet signed and that several questions remained unanswered. Matthew Weston, an analyst at UBS, stated that, given that such measures are being discussed in negotiations with the United Kingdom and Switzerland, he anticipates that the specifics of the trade deal will include safeguards for EU pharma exports resulting from the investigation conducted by the United States. Diederik Steytag, an analyst at ING, added that, despite the fact that tariffs exceeding 15% were not anticipated, nothing is entirely certain until a trade deal is inked, even after the national security investigations have concluded. Without any mitigation strategies, Steytag estimates that these taxes could raise industry costs by $13 billion, with some of that going to the consumer. Courtney Breen, an analyst at Bernstein, estimates that the industry will incur additional costs totaling $19 billion. However, she points out that the measures that businesses have been taking, such as stockpiling drugs and entering into new contracts with contract researchers, might be able to cover some of the costs. Sanofi announced earlier this month that it would be selling Thermo Fisher, a manufacturing facility in New Jersey, where the French pharmaceutical company will continue to manufacture its therapies. Last week, Roche's chief executive officer, Thomas Schinecker, stated that the company was increasing its U.S. inventories to prevent any immediate disruption caused by tariffs. According to Weston of UBS, it was not immediately clear which generic drugs were exempt from duties as a result of the agreement, but any impact on Sandoz, a manufacturer of generic medicines, for this year should largely be manageable. On Monday, shares of pharmaceutical firms Sanofi, Roche, and Sandoz Group all closed between 0.5% and 1% higher.